Investment analysis of TC Energy Corporation (TRP) must first be anchored in the strategic transformation initiated by the spin-off of its liquids pipelines business, South Bow Corporation, which was completed on October 1, 2024. This separation has effectively refined TRP into a focused North American natural gas transmission and power infrastructure entity. The foundational element of the restructured enterprise is its commitment to a long-term, low-risk strategy, which inherently mitigates exposure to volatile energy markets and transition risks. A. Overview of the refocused enterprise and low-risk business model. The investment thesis for TRP is underpinned by exceptional contractual stability, a characteristic defining its utility-like operational profile. Specifically, a formidable 97% of the company's comparable EBITDA is secured by either regulated cost of service frameworks or long-term take-or-pay negotiated contracts. This dense contractual coverage ensures reliable revenue generation across diverse market conditions. The structure of these contracts effectively insulates the company from the primary risks associated with the broader energy sector. This includes bearing minimal commodity price or volumetric risk. For instance, the Canadian natural gas pipeline segment operates under a cost of service framework which provides essential protection in the event of higher costs or changes in throughput volumes. Furthermore, TRP's international ventures, such as the Mexico natural gas pipelines business, are designed to minimize currency exposure, as contracts in this region are largely US dollar denominated. This robust framework allows management to confidently project future financial performance irrespective of short-term market volatility. B. Detailed analysis of the growth pipeline. The stability derived from the contracted revenue base provides the essential funding platform for ambitious growth initiatives. Management has affirmed confidence in the long-term trajectory, extending the target of 5 to 7% annual comparable EBITDA growth through 2028. This outlook, extending visibility for 4 years, is one of the key differentiators in the midstream sector. The foundation of this sustained growth is a secured capital program totaling approximately $25 billion. This backlog is not merely a collection of prospective projects, but comprises high-quality, pre-contracted assets. Over the 12 months leading up to the third quarter of 2025, TRP sanctioned more than $5 billion in new growth projects across its North American natural gas and power portfolio. These newly sanctioned projects strictly adhere to the company's low-risk capital allocation framework, backed by guaranteed revenues derived from 20-year take-or-pay or cost-of-service contracts. However, the scale of this secured growth inherently introduces execution risks. The commitment to such a vast capital program, comprising large infrastructure projects, carries considerable risk related to project execution, including potential shortages of skilled labor, supply chain lead times, and regulatory complexity. Failure to effectively manage these factors can lead to cost overruns, schedule delays, and suboptimal project performance, which would consequently impair the anticipated financial accretion and ability to meet leverage targets. I. Assessment of dividend safety and sustainability. For income-oriented investors, the analysis of dividend safety must extend beyond simple historical track records to examine the underlying cash flow generation. TRP is a prominent dividend payer, boasting a track record of 25 consecutive years of common share dividend increases. A. Dividend history and forward guidance. The recent common share dividend was approved at $0.85 per share for the first quarter of 2025, resulting in an annualized payout of $3.40. This continuation of growth aligns with the company's established goal of growing the common share dividend at an average annual rate of 3 to 5%. This conservative growth rate is explicitly designed to be supported by the growing earnings and cash flow generated through the execution of the substantial capital program. B. Cash flow coverage analysis and the non-GAAP necessity. A rigorous assessment of dividend sustainability requires careful navigation of financial metrics, as reliance solely on generally accepted accounting principles, GAAP, can lead to profoundly misleading conclusions in the asset-heavy midstream sector. Reported payout ratios based on net income per share frequently show significant strain, reflecting the substantial non-cash charges inherent in pipeline operations. For instance, the GAAP-based payout ratio was 102.30% in the fourth quarter of 2024 and reached 105.81% in the second quarter of 2025. Furthermore, third-party analysts project a similarly high payout ratio of 103.88% based on estimated fiscal year 2025 earnings per share. If these high percentages reflected actual cash coverage, the company would be aggressively liquidating assets or cutting the dividend to fund required capital expenditures. The fact that management is able to sustain 25 years of dividend growth and forecast moderate future growth of 3 to 5% proves these GAAP metrics are flawed for structural midstream analysis. The appropriate metric for assessing dividend safety is the non-GAAP measure Comparable Funds Generated from Operations, FGFO. FGO is calculated by taking net cash provided by operations, the GAAP measure, and adjusting it for changes in operating working capital and the cash impact of specific items. This measure serves as the necessary proxy for true distributable cash flow. While the precise FGFO payout ratio is not explicitly available in the provided data, management's commitment to growing the dividend and continuing to sanction highly accretive, long-term contracted growth projects confirms the company's belief that its FGFO coverage is sufficient to, quote, maintain competitive payout ratios. The continued investment-grade credit rating, BBB+/Baa2, provides external confirmation that bond rating agencies believe the cash generation is sufficient to cover both debt service obligations and the dividend requirement. Cash flow dynamics and capital management strategy. The cash flow profile of TC Energy is characterized by the structural necessity of funding significant, long-duration growth projects, which results in a consistent free cash flow deficit. Cash generation metrics. The operational engine of TRP generates strong funds from continuing operations. For the 9 months ended September 30, 2025, the company reported Comparable Funds Generated from Operations, FGFO, $6,225 million, Net Cash Provided by Operations, GAAP, $5,612 million. The funding challenge, capital expenditures, and the FCF deficit. The structural free cash flow deficit arises when comparing available cash flow to the massive capital requirements for both maintenance and growth. Capital expenditures. The net capital expenditures for 2025 are forecasted to be in the range of $5.5 billion to $6.0 billion CAD, with the company tracking toward the lower end of this range due to efficient project execution. This figure includes capital costs incurred for growth projects, maintenance capital expenditures, contributions to equity investments, and projects under development adjusted for non-controlling interests. Deficit calculation. When the estimated annualized dividend obligation, approximating $3.4 billion CAD based on the $3.40 annualized rate, is combined with the substantial net capex forecast, $5.5 billion to $6.0 billion, the total cash required substantially exceeds the 9-month comparable FGFO figure of $6.225 billion. This shortfall confirms that TRP operates under a high-growth model that mandates a continuous structural FCF deficit, a common characteristic among midstream companies aggressively expanding their regulated asset base. The requirement to fund the $25 billion capital program necessitates heavy reliance on external financing. TRP's financial plan involves accessing capital markets, forming joint ventures, utilizing asset-level financing, and strategic portfolio management activities. The extent of the funding requirement is reflected in the extremely tight free cash flow yields reported as low as 0.63% in 2024 Q4 and reaching a negative yield of negative 0.29% in 2025 Q1. This reliance places intense importance on maintaining favorable access to capital markets, which in turn depends entirely on the company's credit profile. The 5 to 7% EBITDA growth is essentially purchased with this external capital, making the investment thesis critically dependent on the continuity of low-cost capital access. Balance sheet health and credit profile.
The balance sheet of TRP is the focal point of investment risk. The company's high leverage is strategically utilized to enhance returns on its stable contracted asset base, but it necessitates careful financial management to preserve its investment-grade rating. A. Core leverage metrics and deleveraging goals. The stability of the underlying cash flows allows rating agencies to tolerate higher leverage than typically seen in non-utility sectors. The magnitude of the debt is substantial, with total debt reported at approximately $61.4 billion. This results in a high debt-to-equity ratio of 163.4%. The key measure monitored by debt markets is the debt-to-EBITDA ratio. At year-end 2024, this ratio stood at 4.8 times. This figure is marginally above the company's publicly stated upper target limit of 4.75 times. The management team has made progress in addressing leverage, achieving significant deleveraging in 2024 despite foreign exchange headwinds, reducing the ratio by 0.3x from the 2023 year-end figure of 5.1x. The proximity of the current ratio, 4.8, to the stated target, 4.75, underscores the ongoing strategic priority placed on proactive leverage management and gradual deleveraging. B. Debt service coverage, a point of constraint. While the cash flow stability protects the enterprise value, the capacity to service debt obligations is comparatively tighter. The interest coverage ratio, calculated on an EBITDA basis, is reported at a constrained 2.1 times. For an infrastructure entity that relies heavily on debt financing, this relatively low coverage provides minimal buffer against unexpected operational disruptions or sudden interest rate increases. Furthermore, total debt is reported as being not well covered by operating cash flow, with only 12.3% coverage. This metric highlights the fundamental financial structure. TRP utilizes its operating cash flow primarily to cover maintenance capital and dividends, relying on external capital markets, refinancing, and new debt to manage the principal of its enormous debt load. C. Investment-grade imperative. Maintaining investment-grade status is the non-negotiable prerequisite for TRP's structural high-growth strategy. The $25 billion capital program cannot be funded economically without access to low-cost debt. TRP successfully maintains strong investment ratings. Standard & Poor's affirms a BBB+ rating, and Moody's Investors Service maintains a Ba2 rating. Both organizations have assigned a stable outlook. S&P's revision of its outlook from negative to stable in October 2025 affirmed confidence in the company's performance and deleveraging commitment. This stable rating reflects the expectation that management will successfully execute its capital expenditure program and manage its debt balance in line with its financial policy. The tightrope walked by TRP is evident in the relationship between its ambitious secured growth, 5 to 7% comparable EBITDA growth, and its elevated current leverage, 4.8 times. The growth plan necessitates significant ongoing external funding, but high leverage restricts the capacity for further debt assumption without triggering a negative rating action. Therefore, the financial risk is centered not on market price volatility, but on execution. Any material cost overruns or delays in placing assets into service would jeopardize the deleveraging timeline, potentially breaching the leverage target and causing a downgrade. A downgrade would increase the cost of capital, fundamentally challenging the economics of the entire growth model. IV. Valuation assessment and relative positioning. Given TRP's significant debt load, enterprise value-based metrics are necessary to accurately assess valuation relative to peers and historical averages, as they incorporate both equity and debt into the calculation. A. Enterprise value to EBITDA analysis. The standard for valuation in the midstream and energy infrastructure sector is enterprise value to EBITDA. TRP's latest 12 months LTM EV to EBITDA multiple is reported at 15.1 times. This current valuation level represents a material premium when compared against its historical performance. The company's EV to EBITDA averaged 12.9 times between fiscal years 2020 and 2024, with a 5-year median of 11.6 times. The multiple experienced a sharp increase, peaking at 17.6 in 2024. Benchmarking TRP against its key North American pipeline peers further confirms its high valuation relative to the sector. Peer Group EV to EBITDA benchmarks. Name: TC Energy Corp. TRP, Enbridge Incorporated, Pembina Pipeline Corp., South Bow Corp., In addition to EV to EBITDA, the non-GAAP forward PE, FY1, is also observed to be rich at 21.44 times, indicating robust market expectations for future earnings accretion. B. Justification of the valuation premium. The elevated valuation multiple of 15.1 times, trading above both its historical median 11.6 and major peers, Enbridge 14.0, is largely warranted by two primary factors: predictability and growth. The market grants this premium because of the high confidence in TRP's cash flow stream, where 97% of comparable EBITDA is contracted, combined with a clearly articulated and secured 5 to 7% comparable EBITDA growth outlook through 2028. Investors are willing to overlook the elevated leverage, 4.8, because the associated growth is structurally guaranteed by long-term utility-like contracts. The valuation acts as a barometer of market confidence. It implies that the intrinsic value derived from the 5 to 7% growth forecast is currently fully priced into the shares. Consequently, the valuation carries an inherent risk. If the growth outlook is materially impacted, for example by funding pressures forcing a deceleration of the capital program, or by sustained execution failures leading to cost overruns, the current valuation premium would quickly erode, leading to material downside risk for equity holders. V. Investment conclusion. TC Energy Corporation, TRP, following the spin-off of Southbow, has consolidated its position as a dedicated natural gas and power infrastructure company with an exceptionally stable operational foundation. The investment case rests on the certainty provided by the company's business model. 97% of comparable EBITDA is secured by regulated cost of service or take-or-pay contracts. This contractual stability de-risks the cash flows necessary to support the ongoing dividend. The dividend structure is secure, supported by 25 consecutive years of increases and targeting future annual growth of 3 to 5%. While GAAP-based payout ratios appear high, for example 102.30% in 2024 Q4, cash flow coverage, appropriately measured by comparable funds generated from operations, $6.225 billion for 9-month 2025, is sufficient to maintain the $3.40 annualized payout. The most profound tension in the investment profile arises from the combination of high leverage and aggressive capital deployment. TRP operates under a structural free cash flow deficit, necessitating continuous external financing to fund the $5.5 billion to $6.0 billion net capital expenditure forecast for 2025. The debt-to-EBITDA ratio of 4.8 is tightly managed near the upper limit of the target range, 4.75x, and the interest coverage is tight at 2.1 times. The maintenance of the investment-grade credit rating, BBB+ and Ba2, both with a stable outlook, is critical, as it directly governs the cost of capital required to execute the $25 billion growth backlog and deliver the secured 5 to 7% comparable EBITDA growth through 2028. In conclusion, TRP is suitable for investors seeking stable income and regulated growth, provided they accept the inherent financial risk associated with high leverage. The stock is priced at a premium valuation, trading at 15.1 times LTM EV/EBITDA, reflecting the market's expectation of flawless project execution and disciplined adherence to deleveraging targets. Investment performance will be largely dictated by the company's success in managing its debt profile and executing its secured capital program on time and on budget.